Welcome to the latest edition of Fitch's Virtual Investor Series. I'm Bob Vrchota, Managing Director of CMBS. Today I'm joined by Melissa Chi, a Senior Director of our CMBS Surveillance team, and Chris Wimmer, Senior Director on our REIT's Corporate Rating team. Today we're going to discuss commercial real estate trends. So let's get started. So Chris, with the ever-evolving war between return to office and work from home, what are you seeing on the office performance side? What kind of challenges are landlords facing, and how has this affected your rating analysis?
Office REITs return same property NOI growth of in the high single digits during the first 2 quarters of 2022. This is after 5 years of low to mid single digits, with the exception of a decline in the single digit range with the onset of COVID-19 in 2020. Most office REITs rated by Fitch followed this pattern. The improvements in NOI notwithstanding, Fitch retains a cautious view on demand for office space. Despite the recovery in office jobs, the actual occupancy of employees in the workplace has not yet reached 2020 levels. Some of this is due to the acceptance of work from home norms aided by virtual tools such as Zoom and Teams, combined with a workforce that doesn't really seem like it wants to come to the office. So in order to capture this in our analysis, Fitch has taken a narrower view on the negative leverage sensitivities on companies that face these headwinds in the office sector, particularly those that are operating in the New York City metro. In addition, we have increased the cap rate that we use to calculate unencumbered assets, which is important in considering alternative liquidity against unsecured debt.
Right. Thank you, Chris. Now, Melissa, turning to you in CMBS, we see a mix of Class A, B, and C quality product in CMBS transactions. What kind of performance trends are you seeing? What kind of challenges are they facing in CMBS? And how has it affected your rating analysis?
Sure, Bob. CMBS has a neutral outlook on office. We expect a bifurcation of asset performance trends over the next several years as the shift to remote working affects individual properties differently. We do believe healthy demand will remain for the newer construction Class A properties located near transit hubs and those that have environmental certifications. Where we do remain cautious are the older Class B and C office, those that have more rigid layouts and have more dated plant and machinery, which make them a little bit more at risk for obsolescence unless significant capital expenditures are invested in them. We are taking a very close look at office in our analysis, differentiating cap rates between Class A and Class B/C properties. While we are conducting surveillance, in many cases, we are raising cap rates higher by 100 basis points on older Class B and C office, and factoring in property location as well as asset quality. In terms of office delinquencies, we've seen a slight uptick from a rate of 1.3% pre-pandemic to 1.9% at the peak of the pandemic. That rate has since fallen to 1.2%, which is well below pre-pandemic levels. And the majority of the delinquent office volume that we see in Fitch's universe is heavily concentrated in pre-pandemic underperformers. More than 40% of that volume really is concentrated in very specific markets, primarily Chicago, Houston, and suburban New Jersey assets. Office was also the only property type that we saw declining NOI trends between 2020 and 2021, down on average 1.1%. Urban properties fared much worse, being down 2.8%, while suburban properties were down 0.7%.
Great. Thank you, Melissa. Let's shift gears a little bit and look at the retail sector. It's a sector that's actually performed pretty well coming out of the pandemic. We've seen increasing tenant sales trends. We've seen a limited number of retailer bankruptcies, and we've actually seen more store openings than store closings this year, which is a trend that hasn't happened in many years. So Melissa, maybe on the CMBS front, what are you seeing in retail and CMBS? What kind of performance trends are you seeing? What's on your radar as far as risks, and how's it affecting your analysis?
We currently have a neutral outlook on retail and CMBS, but there is a heightened chance that that neutral outlook moves to deteriorating should all the factors that you mentioned materialize. The retail sector saw a significant improvement from their pandemic lows as properties reopened from mandatory store closures and lockdowns, tenants repaid their deferred rents, and occupancies increased from new leasing. However, we are concerned about the effects of a recession that would significantly slow consumer spending, as well as inventory and supply chain disruptions, as well as ongoing labor challenges that could further pressure retail sales, thus forcing retailers to continue to rationalize their physical presence and possibly close stores as leases roll. Retail NOI grew 4.9% in 2021, and when you factor in what the 2020 decline in retail NOI was on average of 5.5%, it really puts us back to almost near pre-pandemic levels. We do expect to also, similar to office, see a bifurcation of retail performance. Needs-based grocery and big box retail centers will continue to perform well. Class A malls we expect to continue to perform well. I think where we have been concerned for the past couple years have been regional malls, and primarily the older Class B and C regional malls. We've held a conservative view on malls even prior to the pandemic, and that view has become increasingly more negative, especially on Class B, C malls in the midst of the pandemic. And with that view, we've tiered our mall exposure across our portfolio into 3 categories and really differentiated our credit view through the cap rates that we apply on these different mall tierings. Malls that we considered Tier 1, which are generally ones with sales above $600 per square foot when you exclude Apple, those have Fitch stress cap rates between about 7.5% to 10%. Tier 2 malls are ones we consider having sales generally between $450 and $600 per square foot. Those generally have stress Fitch cap rates of 12 to 15%, and the bottom of the tier 3s, those generally have sales sub 400. Those have cap rates north of 20%, with some even approaching that 30% cap rate. The tiering and mall performance is also evident in terms of the NOI performance that we've seen to date. While Tier 1 malls saw a 3% growth in NOI in 2021, Tier 2 also saw about a 5% growth as well. But I think on the contrast, we saw further declines in NOI for Tier 3 malls, which was down an additional 4% on top of the 21% that they saw, drop in 2020.
Okay. Thanks, Melissa. Now, Chris, Melissa gave us some good color on mall performance. Mm-hmm. Maybe you can give us a little color on the performance of shopping centers, traditional shopping centers. Mm-hmm. What kind of performance trends have you seen, and what kind of rating actions have there been in the shopping center space?
Sure. So shopping center REITs posted NOI growth in the 2.5% to 3% range in the 3 years approaching the pandemic. During the pandemic, property level cash flows were pressured to varying degrees, but this proved temporary as this retail REIT subsector was able to post very strong results in 2021, coming off of very weak 2020 comparisons. Some of these, most of these REITs really benefited from the fact that their tenants are grocers and pharmacists, so really of the essential variety or non-discretionary variety. And in 2022, that's driven occupancies in the mid 90% range, and we're expecting NOI levels in the 4 to 5% range. As a further testament to their resilience, during the pandemic, we didn't downgrade any of the shopping center REITs. Moreover, in 2022, we've actually upgraded 2 of the shopping center REITs, and in each case, providing the grocery-anchored assets in their portfolio as part of the rationale for their upgrade.
Thank you, Chris. Let's turn to rising interest rates and the impact it is having on new issuance volume. Now in CMBS, with the Fed rate hikes in the middle of the year combined with rising credit spreads on bonds, it's really caused mortgage rates at the loan level to rise from 3.5% at the beginning of the year to almost double, to 6 to 6.5% for more recently originated loans. So this has obviously slowed the new issue volume or new issue market for CMBS. Volumes have started out the year pretty strong in the first quarter when rates were low, but we will probably be pretty far off of the $158 billion of issuance we saw last year. There are some positive trends for new issuance in CMBS. We are seeing leverage still stay low. So LTVs for new issue CMBS on average were 53% this year. It's actually down 2 points from 55% last year. Debt yields are actually still pretty strong. They've actually risen a little bit from 10.9% last year to 11.25% this year. And the percentage of hotels, which is a more volatile asset class historically, is still pretty low in new issue CMBS. It's about 6% of new issue CMBS today, and long-term averages are usually about 15%. So that's all positive. There are a few negatives. One in particular is just the percentage of interest-only loans. So we have seen full-term IO loans grow from 70% of all new loans last year to about 80% this year. So maybe Melissa, we'll start with you on the CMBS front. You know, clearly higher interest rates are impacting the new issuance volume, and historically 2/3 of all CMBS loans were refi loans. You know, what are you seeing as far as refi activity in CMBS, and what are you hearing from servicers?
Refinance activity was strong during the first half of 2022, but we are actively monitoring our maturing volume exposure by year-end 2023. For Fitch-rated conduits, we have about $3.5 billion maturing for the remainder of 2022 and about $23 billion in 2023. If you look at their weighted average coupons, loans maturing in 2022 are about 4.25%, and the ones maturing in 2023 are 4.5%. I mean, these are well below what we're seeing where current rates are averaging 6%. You know, and this really poses significant refi challenges, you know, for borrowers that are going to have to refinance into a higher interest rate environment. And for some loans, it may be an issue, especially if there hasn't really been any amortization or significant NOI growth during the loan term. For Fitch-rated single asset, single borrower loans maturing by the end of 2023, the majority of them have ample debt service coverage ratio. You know, they average 2.76 times at year-end 2021. So even though we've seen recent delays in the execution of some of the extensions on these single asset, single borrower loans, we do expect that their low leverage and strong debt service coverage ratios to provide ample cushion for further rate increases that are forthcoming. In terms of what we're seeing and hearing from servicers, we expect to see a slight uptick in special servicing volume as maturity defaults are expected to rise, given borrowers are going to find it more costlier to refi into a higher interest rate environment. We also do expect the improvement in the delinquency rate, that pace of that improvement, that is expected to wane as there's more uncertainty, right, from recessionary concerns, rising rates, and inflation on the volume of resolutions, resolution velocity, new issuance volume, and also property valuations. I think what we have seen and do expect will continue to happen are servicers continuing to grant modifications and extensions, especially for those committed borrowers, where we see property performance continue to stabilize.
Very good. Thanks, Melissa. So, Chris, against the backdrop of rising rates, what are REITs' current needs, and how are they going to address these needs going forward?
Yeah, so the pace has actually slowed in terms of REIT senior unsecured issuance. After 3 years of in excess of 65 billion, for reference, the previous high water mark was 53 billion in 2017. For this year, at the halfway point, REITs issued in excess of 20 billion, but that was less than half in each of the prior 3 years for the same period. And usually, interest rate uncertainty has been cited for the reason for the slowdown. Fortunately, REITs spent the better part of the last decade in that low interest rate environment, increasing balance sheet flexibility and terming out maturities. So for the time being, REITs, for the most part, are able to remain on the sidelines and wait until interest rates, until the interest rate environment clears up and becomes more favorable. To the extent that they need additional capital, these, particularly investment-grade REITs, have large, usually undrawn revolvers to draw from. They have at-the-market equity issuance programs, or ATMs, or they have asset sales from their unencumbered portfolios, among other tools.
All right, very good. Thank you, Melissa and Chris, for your insights today. And thank you for joining us. For more information on U.S. CMBS and REITs, please visit us at fitchratings.com. If you have any questions on the topics discussed today, please send an email to the address on the screen. Thank you for watching.